So, as everyone knows, we have a significant partnership relationship with Goldman Sachs Asset Management. Recently, over the last 6 to 9 months or so, we've been doing more with Goldman Sachs Securities side of the firm. And so from that side of Goldman Sachs, we have today with us David Kostin, who is the Chief U.S. Equity Strategist within the Global Investment Research Department. Mr. Kostin's been with Goldman Sachs since 1994, starting in equity research, and now has accumulated roughly 27 years of Wall Street experience. So he's here to tell us what his predictions are for the U.S. Equity market and what those risks, what the risks are around his predictions. Mr. Kostin, thank you very much.
Thank you very much. I appreciate having an opportunity to come and speak with you this afternoon. I was asked to address a couple of questions with regards to the outlook for the U.S. stock market. And I have responsibility in the investment research department, as was indicated, for forecasting the market. And what I decided to do in conversations with staff in advance of my presentation was to break it into two pieces. A little bit of discussion on the outlook and some of the risks near term. We'll call that the next 1 to 3 years. And then a discussion of the outlook over the next 10 years, with more of a focus on years 7 through 10. So if that's okay with you, but also encourage to ask questions during the presentation in the event that you want to address certain areas of focus. So in 2 slides at the very beginning, one on the near-term forecast. The way that we've developed a framework of thinking about forecasting equity markets is to have 4 legs of a table. Think about the economy, earnings, valuation, and money flow as the base for our forecasting looking forward. And so in a summary, the Goldman Sachs view from investment research is that the U.S. economy will be accelerating in terms of economic activity next year around 3%, and that growth rate's likely to persist for several years at around 3%. That would be 2015, 14, 15, 16, and into 2017. So that's a baseline foundational view in terms of the economy. In terms of earnings, we see earnings rising modestly, about 8% the coming year, another 8% in 2015, and that's slowing over time. But basically the idea of as the economy is growing, revenues are growing, while margins will stay flat, and I'll focus on this risk in a moment, the idea of earnings modestly growing is part of the baseline forecast. The market trades at fair value. The U.S. equity market trades at fair value, in my opinion. I'd like to show you some evidence of how we arrive at that conclusion, which makes it a more challenging environment to identify individual opportunities within the idea the overall market should be rising modestly over the next couple of years. And so valuation we'll look at in a moment, but that is full valuation in my opinion. The last item is on money flow. What is the money flow either into or out of U.S. equities? Who is the buyers? Who is sellers as we think about it in a context of a market level? There must be some buyers, there must be some sellers in order to have that net money flow. So the economy, earnings, valuation, and money flow are the areas that I would go into in a little more detail. But I'll briefly highlight the risks around our forecast. And the risk would be, number 1, on margins, and the idea of level of corporate profitability has been at a peak level for the last 3 years. So margins have been elevated and steady for the last several years. The second, of course, would be interest rates, given the policy changes that are likely in the coming year from the Federal Reserve in terms of the tapering process and their long-term purchase of corporate and mortgage securities. We'll talk a little bit about that. Our view basically is that rates are likely to stay low for the next several years in terms of the Fed funds policy. The policy rate of the government likely to remain very low for several more years, certainly into 2016. So I think that makes the interest rate risk somewhat less critical as we think about forecasting the market. And the third is money flow, and the idea that there could be perhaps more money flow coming into the market than we are currently anticipating. Our baseline forecast is the principal source of capital and demand for common shares in the United States is corporate buybacks. They have been the dominant source of demand for securities. So that's basically an outline of the near-term forecast. If you look a little bit further ahead, what are the ways we think about the equity return prospects for the next 10 years?
Before you go,
Sure.
may I ask a question?
Absolutely, go ahead.
Go under risks to your near-term forecast, interest rates. You say you expect the taper to begin in March 14, but Fed funds will remain unchanged in 2016. Isn't that a bit contradictory in terms of, if you expect a taper, well, I shouldn't say contradictory, so really would I be correct in assuming that you would expect rates to rise more in the longer end rather than the shorter end?
That is correct. The idea
Okay.
that you would have a steepening of the yield curve,
Right, yeah.
if you will. The key issue was the Fed funds. We're likely to see the Fed under the presumed new chairperson, Janet Yellen, strengthen or make more prominent the forward guidance, idea of keeping the Fed funds short rate basically at a accommodative level. It's between 0 and 25 basis points right now, have that persist for several years. That's the short rates. And the long rates, as the Federal Reserve reduces or begins to taper its purchases of government bonds, and right now, the Federal Reserve has been purchasing at a rate of $85 billion per month, about $45 billion per month of purchase of mortgage securities, and about $40 billion per month of Treasury securities. They're likely to begin to reduce those, that rate of purchasing, probably with the Treasuries first, probably starting in March. There's a chance they could start in December, but more likely our view is they will start in March, and that will begin to taper down over time. So in response to your question, we have short rates staying low for a very long period of time. The purchases and the QE, as we call it, of the long-term impact will be moderating, and so the yield curve will modestly rise or steepen. And the idea we don't expect it to rise more quickly is because the economy is not not that strong. It's accelerating, but not so much.
Does that imply a more positive outlook for net interest margins for banks?
It would be a modest positive for net interest margins. Certainly the spread would be there. There's not been a robust amount of loan demand thus far. The mortgage refinancing market, given long rates have gone from 1.7% on 10-year U.S. Treasuries to about roughly 2.7%, there's been a reduction in the number of mortgage originations pretty significantly. So it would be beneficial, generally speaking, for a higher net interest margin. What would be more critical for the profitability of banks is if and this is primarily mortgage lending, some regional banks, would be if short rates were to rise. That was a pretty important from the banking profitability perspective.
Can I ask you about March 2014? And what are some of the underlying factors that are getting you to arrive at March 2014 that they'll begin the taper? What are some of the key factors you're looking at there that's kind of getting you to calling that date, if you will?
So the idea of the economy, I'm going to just jump to a slide because I think picture's worth usually very effective. So let's look for just a moment on page number 8, which I have as the economy, and this is a quarter-by-quarter run rate of the U.S. Economic forecast that Goldman Sachs has. Obviously, we had a shutdown of the federal government in the early part of this quarter, and so the rate of economic activity in the fourth quarter was suppressed. We think that run rate will be roughly at a 3% level as we look into 2014. So that's the run rate that we're expecting. Now, that is the forecast, and the question you asked was sort of the numbers behind the forecast and what would we be focusing on. So the following slide, while this is the annual forecast as opposed to the individual quarters, I think the idea is still the same. So the same way I broke down the forecast for the U.S. equity market in terms of the economy, earnings, valuation, and money flow, we can also look at the U.S. economy and break that into its various pieces. For having economics, for basic macroeconomics, you've got the consumer. It's about 2/3 of the economy. Then you have government spending. You have the idea of corporate spending, and then you have foreign exchange, but the foreign trade. But the way we break it down here is really the consumer and capital spending on the part of corporations. So the argument that we would put forward, or not the argument, but the forecast, the analysis that we look at, is that the consumer, having already experienced the increase in payroll taxes in the first beginning of 2013, that does not that sort of anniversaries or goes away in terms of the rate of change. Remember, economic growth is the rate of change. So we think the rate of change will be more to the positive in terms of economic activity on the part of the consumer. And the second would be corporate spending. Corporate spending has been notably weak in 2013. We think that's going to pick up in the coming year, and we can talk a little bit about that in a moment if you like. But those would be, if you will, the key drivers that, from an economic perspective, would make a difference. And the following page then shows you the examples. So the critical issue is unemployment, and the idea of the labor markets improving modestly, not dramatically, but it's getting better. The unemployment rate around 7.3%. We think that slowly moves lower. Inflation remains under control by all the measures that we look at, and certainly the Federal Reserve appears to be looking at as well. So those two drivers would be reasons, the Fed looking to reduce its impact on the financial markets, and that's why I'll be tapering on the longer end. And that's also the same explanation of why they're likely to be more, maintain that short interest rates at a very low level for a considerable period of time. So that was the issue. Go back for just 1 second. I indicated on the long-term forecast, 7% would be a number if asked, what is the forecast annualized rate of return one might anticipate over the next decade for U.S. stocks? My best estimate, is about 7%. It's obviously a confidence interval around that, anywhere from 7 to 10%. We can talk a little bit about the explanation of how we arrive at that forecast. There's different approaches, and the risks, I'd say there's 4 big risks around that. Margins, I said earlier about near-term corporate margins. That has to do with the profitability. Longer term, it's more of a societal issue, and the idea of the share of the economy that goes to profits and the share of the economy that goes to labor in terms of wages, that is at an extreme over the last 50 years. And we can look at an example of that later, but the idea that may get rebalanced over time, either through higher taxes, this is a societal issue, would be one risk. The second would be interest rates and the idea of how rapidly interest rates would normalize. Again, we think for various structural reasons that will likely to take place very slowly over time, but that would be a risk, identifying a risk. Money flow, we have the baby boom generation as they get closer, they're already entering the retirement ages. Is there a likely disinvestment process? Those individuals will be sellers of their shares. And the final level, which is not something that most people focus on, is the index composition. And if you think about forecasting the market today, and look out in 10 years' time, 1/3 of those companies will be different. You have 500 stocks, 1/3 of them are likely to be new companies. So when we try to forecast the return of the market, there's 1/3 of it we don't even know what's likely to exist. New companies, either through mergers, going out of business, companies become too small, other ones come in. Just think of the nature of what's happened in our own economy in the last decade. So that's a key variable, and in forecasting, we obviously try to make some adjustments for that. So those are basically the 2 areas. I could highlight a couple of examples or exhibits that I think are interesting as you think about your own responsibilities in asset allocation and investing. This is the near-term forecast of the market over the next several years. I'd emphasize the fact that over time, earnings drive stocks. And that's why we spend so much time trying to forecast earnings for the market, different sectors of the market. The idea over time that is a link between the profitability of companies, broadly speaking, and the level of the market is worth keeping in mind. The idea of U.S. corporations will earn about $108 per share in S&P 500 earnings per share terms this year, $108, going to $116 and going to about $124 as you look into the year after that. I want to underscore very clearly that there's a near-term risk to the market, and that is that we are up 40% gain in the U.S. stock market in the last 18 months, and we have not had a 10% drawdown. So it's an unusually long time for the market to be rising in a steady fashion without some kind of a pullback. And I emphasize this particular chart worth thinking as an investor. The market since 2009, the low, has gone from 668 to almost 1,800. So an enormous rally. But intra-year, you've had, for example, in 2011, the market fell 20% during the course of the year. You've had the market fall 16% in 2010. You've had it fall just 6% this year. But the message is that in the context of a market that's rising, So intra-year, you have oftentimes very large pullbacks. We have not had one in some time of meaningful size, and over the last 40 years, on average, you should anticipate a pullback of approximately 12% in the course of a year. You would expect at some point the market to hit a peak and then fall by 12%. Now, the market may recover during that same year, so the market may be up, but over time you should expect that kind of this is not volatility. We're not measuring volatility. We're simply measuring the drawdown and showing what that is likely to be. So as we go forward in forecasting the market, that is part of the assumption that there will be some type of a drawdown. I said earlier a risk of margins, and I find that a picture is very informative to understand and think about the context around the risk. So corporate margins, as you see on the left side of this exhibit, have been generally up and to the right for 40 years, with some cyclicality around recessions. But the idea of the economy and margins basically have been moving up and to the right. But as we look in a more concentrated period of time, the last several years, margins have been basically static. Net profit margins for corporations in the S&P 500 basically just under 9%, somewhere between 8.6 and 8.8%, pretty steadily since 2011. That's 2011, 2012, and 2013, and my forecast over the next several years will likely remain at that level. That's important to understand because profits are so sensitive to the level of margins. And every 50 basis point swing, 50 basis points is a small number, is about $5 per share in the S&P 500. $5 a share at a 15 multiple, use that for an example, it's about 75 points in the S&P. So it's a way to think about margins as it affects earnings and earnings affecting valuation. So this is, I think, a key risk. Companies in their quarterly conference calls every 90 days have talked for the last 2 years about how they're struggling to maintain their margins at the current level. That they're really been difficult for them to pass through any incremental costs to the consumer. If you jump ahead for just a moment, on page 11, I spoke just a moment ago about the economy. So we'll look about valuation. This is our various approaches to forecasting fair value in the U.S. stock market at the end of this year, and we can also, of course, roll forward to a future year. But on average, these different approaches would give you a valuation approach of around 1650. Market obviously trading well above that. But I think these averages are what that word means. It's an average. There's a reasonable distribution, but most of them are concentrated closer to where we are now, giving us a conclusion that market is close to fair value. The one approach that gives you a notably lower valuation conclusion would be the cyclically adjusted PE ratio. And so in one slide each, I'll run through each of those 5 approaches to give you a perspective about how we think about it. Starting at the bottom, you can see on this slide, this is the cyclically adjusted PE ratio. Graham and Dodd wrote about this many, many years ago. Professor Schiller at Yale, who just won the Nobel Prize, has focused quite a lot of his research in this area, among other areas that he's focused on. And the way of looking at this level of profitability is to look at a PE ratio based on the last 10 years of earnings. Sort of adjusted, cyclically adjusted for the nature of the economy. And this would suggest and give you a conclusion that the market is trading anywhere from 15 to 30% over fair value. That is the conclusion of this chart. The idea you're trading operating PE ratio around 20, rolls long-term average around 16.7 times. So that gives you that sense of potential overvaluation. If we look at a model that incorporates some of the U.S. economic data, the output gap or inflation as examples, it would forecast a multiple at the end of this year of close to 13 times. It'll be 13 times forward earnings. Right now, the market's trading anywhere from 1 to 2 points, multiple points above that. So this is an approach. It's an approach we use. One of the ingredients in the recipe we think about valuing the market would suggest the market's a little bit above fair value. I put a lot of focus in the area of return on equity, how profitable companies are, and how do we link that to the valuation of the market. And so here, corporate profitability, as you see on the left, is high, around 15.5%. The valuation or the profitability of the financial industry is much lower than average, under 10% return on equity. And if you look at the rest of the stock market, it's pretty high, it's over 18%. But on average, overall, the market, around 15.5% return on equity. And historically speaking, when the return on equity is at that level, the price to book value of the market is around 2.5 times. That's exactly where the market trades today. So by this conclusion, you would arrive at a view that the market's around fair value. And the third, one of the key reasons for a higher profitability relates to the fact that borrowing costs and interest rates are so low, and the idea that tax rates are particularly low. So the last item would be look at the Fed model, and relate the valuation of the stock market to the valuation of the bond market. And the way we think about this is what's the earnings yield of the market, what's the inverse of the PE ratio, earnings yield, and what's the yield on 10-year U.S. Treasury securities. It's around 2.75%. You could look at BBB corporate bonds. You could look at TIPS, inflation-protected securities, a variety of different approaches can give you a similar kind of conclusion. And this matrix on the right is a way of involving yourself in the process. Think about where you think interest rates might be along the top, and then think about how that gap is likely to close between bonds and stocks. So is it that the bond market is more reasonably valued and equities will move towards bonds, or will go in the other direction? And that's the way we think about sensitivity. The typical way of applying the Fed model is to have those compress or move together from either direction. And that will put you right around fair value today. So those are.
Can you address that, right? Because correlations move, and like you look at Greece, right? And what happens is they both move out, right? There's not a convergence. There's a pressure that comes from, right? We're the largest debtor nation in the history of the globe. You know, I know people say, okay, we have the reserve currency, so it doesn't matter. We can't go to a Greek-type environment. But there are other countries that have been able to issue their own currency, and they absolutely went through that, right?
If I think about the question you're asking, is the correlation in the relationship between PE ratio and yield. So let me go all the way to the back of this presentation.
I call it the 87 effect, where rates come down and stocks come in, right? That's convergence, right?
Mm-hmm.
Versus bonds go down and stocks go down, right?
So if we look for a second at page 44, we've basically been in two different regimes. I want to think about that. One, and sort of the back, we look at the idea of interest rate normalization. What is the risk of the relationship between bonds and stocks? So on the left side, you see the period of time from mid-1970s through the end of the millennium, to 2000. There was a classic relationship, which is you move lower, higher bond yields move along the bottom. You see you had a lower PE ratio. That was the experience for 25 years. But for the last 14 years, you've had it in a different relationship. That and it has to do with the different environment. Now you could talk about this is going to incorporate part of the high level of technology stocks, the peak of the bubble. So I guess the answer I would come to you is that the relationship between stocks and bonds is not the same. It's dynamic. And if you see on the right side of the same slide, you see that over time there's been a regime where there was a high degree of correlation, or somewhat lower degree of correlation. Our argument would be, or my view, is that rates, while they're not, they're artificially low or they're unusually low for various exogenous reasons, that they're likely to normalize more slowly over time as opposed to gap dramatically higher. I mean, there are certainly risks in the world. There's liquidity in the bond market. You saw what happened in the case of the Chinese when they tried to diversify their reserves away from the dollar and they put into Europe. We saw what happened there. So there's no constant in the world, but the idea of the bond market yields normalizing more slowly over time, I think, is a view that we certainly have. And the idea of why is it that rates would be rising? Is it rising because there's better growth? Is it rising because there's more concerns about inflation? So ultimately, what is the driver of the higher rates? And the view is we'd like to see more growth. A little bit arguably, we have inflation at 1.6%. We can certainly tolerate higher inflation. The goal of the Fed is closer to 2%. So we don't really have an inflation issue. We certainly could have more jobs, so we have more of a labor issue. So we don't really see that there's a risk near term that rates are going to move dramatically higher so rapidly.
Two questions. Number one, where do the dividends on common stocks fit into this whole picture, number one? And number two, going back probably over the last year, or a year ago, there was an indication that I think there were only 2 times in the last 20 years when the yield on the S&P exceeded the 10-year, and that would be an indication of a better market. Does that thesis hold any water?
Oh, yeah, so actually, let's, both those questions relate to kind of a long-term forecast. So if you look for a second on page 24, try to give you a perspective if you think about the forecasting process over the long term. So we have a distribution, as I said at the very beginning, forecast on average would be about 7% annualized return to stocks over the next decade, and the probability of them outperforming bonds, for example, close to 90%, probably a little higher than that, outperforming inflation, and I think there's 99% likelihood that you'll get a positive return on stocks in the next decade, on average. That's sort of the distribution. There on the following page gives you some specific numbers around that midpoint and some degrees of confidence as we think about the forecasting process. Again, we're forecasting out a return over the next 10 years, so there's some level of uncertainty around that. But specifically to your question on the relationship of bond or dividend yields, if you look for a moment on page 36, this is looking at the history of the last 50 years. What's the dividend yield been on the market? And so on average, over the last 130 years, you're looking at over 4% dividend yield. You look after 50 years, last 50 years, dividend yields 3%. In the last 20 years, it's around 2%. So we've been in different inflationary environments, different interest rate environments, but the idea for dividend yields, it's always useful to understand what is the time series and the context that we're talking about. Another way to think about that same information is to think about it in terms of a distribution. That if the average is 4% over, I guess, at 130 years, the last 50 years has been averaging around 3, and we're obviously at the lower end, around 2%. What does that tell us? Well, it tells us the following. We actually forecast the level of dividends in the market every year for the next 10 years. And we trade that. And there's a market for the level of dividends. Just like there's a forecast and a traded market for the level of dividends in Japan or in Europe or in the UK and the FTSE. Why do I emphasize this? It's because you have a view of the capacity of a company to pay that dividend and the propensity or the willingness of management to give it to you in the form of a dividend as opposed to buying back stock or investing the capital. So we think about forecasting dividends. There's the capacity, how fast the economy is going to grow, how fast will earnings grow, and how much of that what's the payout ratio likely to be. And so on the following chart on the right, on page 37, you can see that it's not just the level or the capacity of a company to pay the dividend, what's their propensity. And they have been reducing, they being corporations, have been reducing the amount or the percentage that they will pay out to shareholders as a dividend for the past 50 years. That payout ratio has been declining, and it's been hovering now around 33% of the earnings of a company are being paid out in the form of dividends. So we think about this in terms of what's the valuation of the market going to be in 10 years' time. We have a forecast of dividends. I just showed that to you. And the following chart is a way to sort of position ourselves around what kind of dividend growth do we expect and what kind of dividend yield is likely to happen in 10 years' time. And so what you see in this particular chart is there's various options. If you were to assume for just a moment that the dividend growth is around 5.5% per year for the next 10 years, dividend growth. Remember, the U.S. economy growing on average around 3%, inflation around 2%, just made that as an assumption. That's 5% revenue growth, effectively. And so if companies are basically keeping their payout ratio constant, you basically would expect, all else being equal, your and so margins are already very high level, so we're not assuming margin improvement. Your dividends are likely to grow in that range. That's not how we forecast it, but in a reductive sense, that's the idea. It's nominal growth in the economy is going to basically determine your dividend growth. And the second is, what's your dividend yield going to be like? And so there's different assumptions. Let's assume it's 3% for a moment. You can then back in the level of the market. The level of the stock market is going to be in 10 years' time, looking at it through the lens of a dividend, and the kind of return that you're likely to get over that period of time. On the other hand, dividend yields could stay closer to 2%, kind of closer to where they are now. the idea that companies are not going to be paying out quite as much, and they want to be reinvesting that money and getting a return on equity. ROEs we saw was about 15%, so the idea of companies investing in the business, those are variations of that. Our baseline forecast is the annualized return to the stock market closer to 7%. This is an approach assuming that you're anywhere from 2 to 3%, you'd be anywhere from 5 to 8% at that level. So it's a good question. I think the idea of dividends is an important underlying strategy as the baby boom generation is getting older and retiring. The people looking for income, companies themselves are been raising their dividends now for this year. They'll probably raise it about 11%. Our forecast is dividends will grow 12% in the coming year. The idea that companies are paying out a meaningful amount of their dividends is important. So this is how I would answer your question about how do you think about the valuation of the market through the dividend lens. That's what I think about it. Let's go through one subject on the idea of money flow, which I think would be of interest to many here. It's on page 17. We've seen a notable shift in the sources of demand for U.S. stocks. After 5 years of consistent outflow, mutual fund investors selling and reducing their allocation to equity investments. This year, there's been a pretty steady increase. You've had now in the order of about $170 billion of money coming into equity mutual funds. Remember that, or not remember, but make that identification. A lot of that's actually going to its international funds, investing in international stocks. So there's a certain amount that's coming back into the U.S. stock market from individuals. On the right side, we look at what pension funds have done. This is data from the Federal Reserve. You can see that over the past decade, the defined benefit programs have reduced their equity allocation from around 55% to around 40% over the past decade. And you can see that allocation over time. Why is this relevant? On the following slide, you can actually see the ownership of the stock market. And the U.S. stock market today, just over about 55% of the stock market is owned by individuals. About a third of that is owned directly, and about 20% indirectly via mutual funds, but those are about 55%, and about 17% or so is owned by the retirement industry, whether that's both public pension funds or corporate pension funds, so the pension funds broadly speaking. So those two categories, around 70% of the U.S. stock market. As we think about that, it's worth emphasizing that exchange-traded funds, ETFs, and hedge funds, somewhere around 3 or 4% of the ownership of the market each. So it's relatively modest in terms of their ownership share, higher trading volume, but generally speaking, less influential in terms of size. So one of the things we do is we forecast the demand for shares from each of those ownership categories. Where is there increases? Where are there likely to be decreases? As I said at the very beginning of my remarks, that corporate buybacks, the demand for shares, remains the largest single source by a wide margin, the largest source of demand for common shares. About $450 billion of net demand for 2011, 12, 13. Our forecast next year, similar pace. Companies, very high margins, directing a lot of that money back towards repurchasing shares. The other extreme, if companies are buying back stock, they have to buy it back from someone, and they are buying it back from households. Households have been reducing their ownership in the market directly, and oftentimes that's been recirculated back via ETFs and through the mutual fund industry, and you can see that in the different categories. So that's worth emphasizing. The reason it's worth emphasizing is because the concept of the great rotation, this idea that money is going to go from bonds to stocks, is I think that is not an accurate description of what's taking place, and is what is likely to take place. And by that I mean the following. If you look on page 21, you can see this is the ownership of the bond market. So we looked a moment ago at 70 years of history of ownership of the stock market. Now we can look at ownership of the bond market. The bond market, interestingly, is owned about a third by those same three categories that in the stock market own 70% of the market. So mutual funds, pension funds, and households collectively own about 70% of the stock market. They own about 1/3 of the bond market. And the reason this is relevant, okay, on the following slide on page 22 is because the bond market is twice as large. So it's about $35 trillion in size. You can see the different categories. There's treasuries, there's munis, there's corporates, and there's agency securities. Those four different categories, about $35 trillion in size, that market. Put that in context, the U.S. stock market is about $15 trillion. Put that in context. But we look at the ownership of the bond market, not all of those owners can actually buy stocks. So I try to highlight here, for example, the Federal Reserve owns quite a lot of agencies and government securities. They cannot legally buy equities. The idea here is, what is the potential to rotate, this great rotation into equities? And I think it's more modest than maybe many are led to believe, either through popular press or when you actually look at the data. It suggests that even if all of these owners of $12 trillion of bonds were to shift, just how much of that's likely to shift? I made an assumption here for a moment. If 5% of that money shifts, which would be a lot, it's not going to happen immediately, but that'd be about $600 billion. And put that in context, share buybacks, corporate buybacks, around $450 billion. So the idea is, yes, over time, I do believe you'll get some reallocation. I think it will be less dramatic than many are anticipating. I think it will be much slower. And I just want to put that in context from a money flow point of view. Just finally, I was asked to address some of the longer term risks. And if we look here for a moment, there were a couple of issues. One is on page 43. As I said, there are four issues I would identify as long-term risks that worth focusing on. The first is this margin concept. And the idea on the left side, you see that net margins, corporate margins, stand at record high levels. Now, part of that is the whole U.S. equity market has shifted. Think about within the technology space alone, you had hardware companies and software companies, and now more cloud-based internet companies. There's an inherently higher margin business, as you don't have you got shipping product. It's all done sort of in the ether, in the proverbial cloud. And so margins, as you see Six Sigma manufacturing process, just-in-time inventory. You see outsourcing, offshoring. You see lower tax rates, lower interest expense. A lot of reasons why margins that are very, very high levels. And are they likely to persist at these high levels, over long term? Probably not necessarily rising. And the second on the right side is the share of the economy that is garnered by labor, or the share of the economy that goes to capital. That's been a notable shift within the last 50 years. And so the question is, we think about as a society, where is that likely to rebalance? Margins would be an important issue in terms of profitability. And as I said earlier, over time, profits and earnings drive stocks. We talked earlier about the relationship between bonds and stocks, and our view is that rates likely to rise, but more modestly. If there were to be reasons for to have a shift higher quite rapidly, that would be, I think, a risk. Again, not part of our general forecast. I think demographically, there's certainly an issue. We can look at it in different perspectives. One is the structure, the age structure of the U.S. population as we age as a society. Is obviously some people are just being born. There's a net population increase, but there's a bulge. It's a baby boom generation as it gets older, and we see that historically over time, people tend to reduce their ownership in equities, and as the largest share of society is aging, there'll be a reduction that's more influential than there has been in previous generations. And so that's something that we think about. On the other hand, as I just showed you before in terms of the share demand for stocks, there's international investors, there's other sources of capital, and this is something we certainly think about as a risk longer term.
Just on that point, as long as rates stay relatively low, will that mitigate the traditional reduction in equities by older people?
Yeah, I think it's an excellent point. There's a lack of yield opportunities elsewhere, and so whether it's a dividend-oriented strategy within the equity market or other just owning stocks in general as a way of getting some income would be sort of generally more preferable to owning fixed income. As I said earlier, my forecast is that there's probably a 90% probability that equities will have a better return than bonds over the next 10 years. So I think that's
But having said that, would that by definition almost indicate that high-quality blue-chip dividend-paying stocks will outperform, or does that not necessarily?
So the question is, with would high-quality blue-chip stocks necessarily outperform? The question is outperform what? So if we say, broadly speaking, the market,
Yeah.
okay? Dividend growth as a strategy, I believe, is likely to be a strategy that does outperform over time. The idea of identifying companies that are paying both current yield and then, more importantly, growing the yield. But that does not necessarily have to be the largest cap stocks, necessarily. If we're looking for the fastest growth, if we look back a year ago to give you a sense of the investment process, technology stocks today are the largest payer of dividends in the market. Technology stocks, many of whom did not pay a dividend 2 years ago. Some household names you could think of, where there's been large increases in the dividends, initiation of dividends, as companies are basically looking to distribute more cash to shareholders. So the idea of owning a group of stocks over time, I think it's a dynamic process. But the answer to your question, how I would interpret your question, which is a dividend-based strategy, I believe, is a successful way of outperforming the stock market over time in this environment. The last item, the last slide that I have to share with you today, really relates to the idea of the turnover in the market. So as we are forecasting the stock market today and looking out, whether it's 1 year or 10 years, but particularly as you go further into the future, the idea that this is an organic enterprise, and whether you looked at the Wilshire 5000, we look at the S&P 500, which is we tend to do a lot of work, or the Russell 2000, those are constantly changing companies. Not necessarily every day, but over time, on average, about 5% of the stocks in the S&P 500 will be replaced in a given year. And so you look over a 10-year period of time, it's close to a third of the stocks will be different in 10 years' time than they are today. And there's a survivor bias. And presumably, stronger companies are entering the market, and less strong companies are either being merged or removed from the index. And so the idea of owning stocks, you're owning an entity. And that's the argument, if you will, why index over time has had a better return or a stronger return than the overall U.S. economy. The economy can grow 3%, and the stock market has grown because you have a better subset of the economy, if you will, that's growing. In addition, of course, a lot of these companies are also about just over a third of the revenues are taking place internationally. So to the extent that the rest of the world is also growing, they also will benefit. So I know I have a certain amount of time was allocated. I'm happy to take questions or
Let's throw it open for questions. You've been asked some as you went along, so I
Right.
presume everybody's exhausted with questions.
so.
I guess one I would have is, as you think about, we've kind of hit a little bit on this with Ed's question about capitalization or styles within the market itself. If you had to place an allocation today, is there a certain style or market cap within equities you would recommend one over the other?
So I think it's an excellent question. Is there a certain style we would recommend now? And I would answer your question by saying the market trades at fair value. It's a strong view I have at this time, which means that certain styles, it's very difficult to identify a style that is either mispriced relative to another. There are certain themes inside the market that we look at. I would say, in general, we would find growth more attractive than value. And the idea has to do with the fact that the multiples have compressed. And so the spread of multiples is very narrow, and therefore the idea you can buy growth for not a lot of premium relative to value would be an approach we would look at. There are other strategies about companies that are investing more in their business from capital spending, for example. Companies that are buying back stock. There's sort of different pockets of strategies that we've been emphasizing with our clients. But in general, because the market trades at fair value, it's very hard to say something is sort of notably cheap. Even when we look at the sectors of the market, there's some sectors that are somewhat more overvalued, like consumer staples, and some a little more undervalued by technology, but not dramatically so. So we're sort of left with the idea the market is likely to rise modestly, maybe 5% return in the next year. 1,900 will be a price target 12 months from now, but it's not as though there's something that's dramatically undervalued.
You're still seeing a lot of correlation among the stocks themselves.
Correlation is high. Dispersion of returns is narrow. I think the more interesting observation is that the dispersion of multiples, the idea of the spread of the PE ratios is so narrow, is I think one of the more notable disconnects in the market, that everything is trading very, very similar PE ratio, and that gives the argument, as I said earlier, of buying faster growth for not a lot of premium.
With a high level of stock buybacks by companies, historically, they tended to buy more stock at higher prices rather than lower prices?
It's an excellent observation, and the answer is yes. In 2007, they spent about a third of their cash, which was directed think about the ways that companies can spend cash. They could buy back stock. They can do research and development, R&D. They can merge, use cash for mergers, and they could return cash to shareholders via dividends and buybacks. So when they tend to increase their buybacks, they've not historically been great market timers. 2007, they spent a third of their cash. 2009, at the low of the market in a generation, they spent only about 12% of their cash in that direction. Well, I appreciate having the opportunity to speak with you today, and obviously contact me if you have additional follow-up questions. Thank you.
Thanks very much, David.
Excellent.